Picture this. While you were sleeping last night, something unprecedented happened in the precious metals markets that's sending shockwaves through Wall Street and beyond. Gold and silver just experienced one of the most dramatic coordinated crashes in recent history, and the fingerprints are all over two of the world's most powerful exchanges, the CME in Chicago and the Shanghai Futures Exchange. We're not talking about a gentle correction here. This was a calculated surgical strike that vaporized billions in market value within minutes. Traders woke up to margin calls. Investors watched their portfolios bleed. And the big question everyone's asking is, was this a natural market move or something far more sinister? The evidence is mounting, and what we've uncovered will shock you. From suspicious trading patterns right before the collapse to the uncanny timing between CME and Shanghai, the pieces of this puzzle are starting to fit together in a disturbing way. Major institutions are scrambling for answers, retail investors are panicking, and the mainstream media, they're staying suspiciously silent. In the next few minutes, I'm gonna walk you through exactly what happened, show you the data that's being hidden, and reveal who might be orchestrating this massive wealth transfer right under our noses. This affects your portfolio, your savings, and possibly your financial future. If you want to protect yourself and stay ahead of this crisis, smash that like button right now. Let's expose the truth together. So let me take you back to exactly when this all started unraveling, because the timeline here is absolutely critical to understanding what we're dealing with. It was late Sunday evening, Eastern Standard Time, when the Asian markets were just opening for their Monday trading session. Gold was sitting comfortably around $1,800 per ounce, silver was hovering near $24, and everything seemed relatively stable. Investors who had positioned themselves in precious metals were feeling pretty secure, especially given all the economic uncertainty we've been seeing globally. But then, right around 11 p.m. New York time, something strange started happening on the Shanghai Futures Exchange. The selling pressure came out of nowhere, and I'm not talking about normal profit taking or even a bearish sentiment shift. This was an absolute avalanche of sell orders that hit the market with such force and such precision that it immediately triggered alarm bells for anyone watching the charts in real time. Within the first 30 minutes, gold had dropped nearly $40 per ounce. Silver, which is always more volatile than gold, got absolutely hammered, falling almost $1.50 in that same window. Now, experienced traders know that precious metals can be volatile, but this kind of movement in such a short time frame, especially during relatively low volume trading hours, is exceptionally rare. But here's where it gets really interesting, and this is what caught my attention immediately. Almost exactly 2 hours after the Shanghai selling began, right as their market was hitting its stride in the panic, the CME Group's Globex electronic trading platform in Chicago saw an identical pattern emerge. The same type of massive sell orders, the same algorithmic precision, the same devastating effect on prices. It was like watching a perfectly choreographed dance, except instead of beauty, you're watching wealth destruction on a massive scale. The coordination was so obvious that traders on both continents started flooding social media and trading forums asking the same question: what the hell is going on? Now, let me explain something crucial about how these markets operate, because understanding the mechanics is essential to grasping why this event is so suspicious. The CME Group, which stands for Chicago Mercantile Exchange, is the world's largest derivatives marketplace. When you're trading gold and silver futures in the Western Hemisphere, you're almost certainly doing it through CME. It's the benchmark, the standard, the place where price discovery happens for North American and European markets. Shanghai, on the other hand, represents the massive Asian demand for physical precious metals, particularly from China, which is the world's largest gold consumer and has been actively accumulating gold reserves for years. These two exchanges don't usually move in such perfect harmony, especially not during off-peak hours. Yes, they influence each other, absolutely. Arbitrage traders make sure that prices don't drift too far apart between markets. But what we saw wasn't normal arbitrage or market correlation. This was simultaneous, aggressive selling that appeared designed to trigger stop-loss orders, force margin calls, and create a cascading effect that would drive prices down far beyond what any fundamental news would justify. And that's the key point here. There was no fundamental news that would explain this kind of dramatic move. Think about what typically drives major moves in precious metals. You've got geopolitical tensions, currency devaluation fears, inflation data, central bank policy announcements, major economic reports. These are the catalysts that move gold and silver in significant ways. But on this particular Sunday night going into Monday morning, there was nothing. No surprise announcements from the Federal Reserve, no unexpected geopolitical crisis, no major bank failure. Nothing that would rationally explain why investors would suddenly panic out of their gold and silver positions in the middle of the night. And yet, the selling was relentless. Let me walk you through what happened to actual traders during this event, because the human cost here is significant. I've been in contact with several professional traders and retail investors who got caught in this meat grinder, and their stories are both terrifying and revealing. One trader I spoke with, let's call him Marcus, had been holding a substantial position in silver futures. He's been trading for 15 years, manages risk carefully, uses stop losses appropriately, and generally knows what he's doing. Marcus went to bed Sunday night with his positions in good shape, reasonable margin cushion, everything looking stable. He woke up Monday morning to find that his entire position had been liquidated. His account had been hit with massive margin calls, and he'd lost more than 60% of his trading capital in a matter of hours while he was literally sleeping. Now you might think, well, that's the risk of trading futures, right? And yes, leverage cuts both ways. But here's the thing that Marcus pointed out to me that I found absolutely chilling. His stop-loss orders were triggered at prices that the market only touched for literal seconds. The selling pressure drove prices down to levels that seemed specifically designed to trigger the maximum number of stops, and then prices partially recovered almost immediately afterward. It's a pattern that professional traders call stop hunting, and when it happens on this scale, across two major global exchanges simultaneously, it raises serious questions about market manipulation. The Shanghai Futures Exchange showed similar patterns. Reports from traders in Asia described what they called ghost volume. Massive sell orders that appeared to come from institutional-sized accounts, executing with algorithmic precision during times when liquidity was naturally lower. When liquidity is low, it takes less volume to move prices dramatically, which means if you wanted to manipulate prices downward, you'd choose exactly these timing windows to do it, and that's precisely what appears to have happened. The sell orders weren't spread out over time like normal institutional selling. They weren't responding to news or fundamentals. They hit the market in concentrated waves, perfectly timed to maximize impact and minimize the capital required to move prices. Now let's talk about who might have the motive and the means to execute something like this. Because this is where the story gets really complex and honestly quite disturbing. We're talking about entities that would need several specific capabilities. First, they'd need access to enormous amounts of capital to place these kinds of orders. Second, they'd need sophisticated algorithmic trading systems that could execute across multiple exchanges simultaneously. Third, they'd need to be willing to take short-term losses on these trades because driving prices down artificially isn't free. You're selling assets at progressively lower prices. And fourth, they'd need some kind of larger strategic goal that makes these short-term losses worthwhile. So who fits this profile? Well, there are really only a few candidates. You've got major investment banks, some of which have been fined in the past for precious metals manipulation. You've got sovereign wealth funds and central banks, which have obvious interest in controlling precious metals prices since gold is often seen as a competitor to fiat currencies. You've got large hedge funds that might be taking massive short positions and need to drive prices down to make those positions profitable. And then, perhaps most interestingly, you've got the possibility of coordination between state actors who might have geopolitical reasons for wanting to destabilize precious metals markets. Let's examine that last possibility for a moment because it's the one that keeps me up at night. China has been accumulating physical gold for years, officially and unofficially, through various state entities and private companies with state connections. Russia has also been a massive buyer of physical gold, explicitly as a way to diversify away from dollar-denominated assets. Both countries have stated policy goals of reducing dollar dominance in international trade. Now, if you're a strategic planner in Beijing or Moscow, what would be more attractive? Buying gold at $1,800 per ounce or buying it at $1,700 per ounce? The answer is obvious. And if you had the capability to temporarily crash the paper price of gold through futures market manipulation while simultaneously buying physical gold at those depressed prices, well, that would be quite the strategic coup, wouldn't it? But it's not just about Eastern powers potentially manipulating Western markets. There's an equally compelling argument to be made that Western central banks and their allied institutions might have reasons to suppress gold prices. Think about it from their perspective. Central banks have been engaged in unprecedented monetary expansion for over a decade now. They've printed trillions of dollars, euros, yen, pounds, all in an effort to stimulate economies and manage debt burdens. Gold is the traditional hedge against currency debasement. When gold prices rise significantly, it sends a signal to the market that confidence in fiat currencies is declining. That's not a message that central banks want broadcast loudly, so there's a plausible motive for Western monetary authorities to want to keep gold prices suppressed, or at least prevent them from rising too dramatically. The evidence for this isn't just theoretical. We've seen documented cases of precious metals manipulation in the past. In 2014, the German financial regulator BaFin found that Deutsche Bank had manipulated gold and silver prices. In 2020, JP Morgan Chase paid nearly $1 billion to settle charges of precious metals market manipulation that had gone on for years. These weren't small-scale operations. These were systematic, long-running schemes involving some of the world's most powerful financial institutions. So when I tell you that this recent coordinated crash across CME and Shanghai looks like manipulation, I'm not engaging in conspiracy theory. I'm looking at a pattern of behavior that has been proven to exist in these markets before. Now let's get into the technical evidence that supports the manipulation thesis, because the data here is really quite damning when you dig into it. Several independent analysts who specialize in market microstructure have examined the order flow from both exchanges during the critical hours of the crash, and they've identified some extremely suspicious patterns. First, there's what's called layering and spoofing, which is an illegal practice, where traders place large orders they have no intention of executing just to create the impression of selling pressure, which drives down prices, and then they cancel those orders before they're filled. Multiple instances of this behavior were documented during the crash window. Second, there's the issue of the trade timing precision. When you analyze the timestamps of the major sell orders across both Shanghai and CME, they show a level of coordination that's statistically unlikely to occur by chance. We're talking about order placement that's synchronized within seconds across exchanges that are separated by 12 time zones and operate on different technological infrastructure. The probability of this happening organically without coordination is astronomically small. It is like watching two people in different countries flip coins and getting the exact same sequence of heads and tails 50 times in a row. Theoretically possible, but practically, you know something else is going on. Third, and this is perhaps most telling, the recovery pattern was just as suspicious as the crash itself. After the initial wave of selling drove prices down and triggered all those stop losses and margin calls, prices began to recover, but not in a natural way. Instead of a gradual climb back up as bargain hunters entered the market, prices jumped back up in sudden lurches, almost as if whoever had been selling suddenly reversed course and started buying. Some analysts have suggested that this is exactly what happened. The same entities that crashed the price were then buying back their positions at the artificially low prices they'd created, essentially profiting both from their short positions and then from the recovery. But here's where the story takes an even more sinister turn. And this is information that's been quietly circulating among professional traders but hasn't gotten much mainstream attention. In the days following the crash, several large physical gold dealers reported unprecedented buying activity from institutional clients. We're not talking about retail investors buying coins in small bars. We're talking about orders for physical gold in quantities measured in tons, not ounces. The timing is highly suggestive. Right after the paper price of gold got crashed on the futures exchanges, massive buying of physical gold occurred. This creates a disconnect that's fundamental to understanding the manipulation. Paper prices got hammered, but physical demand actually increased. That's not how normal markets work. In a normal market, lower prices should reflect either reduced demand or increased supply. But here we saw lower prices and increased demand, which suggests the price move was artificial. This disconnect between paper and physical markets has been growing for years, but this recent event brought it into sharp focus. The futures markets, where most price discovery happens, are essentially just contracts, promises to deliver gold or silver at some future date. Very few of these contracts ever result in actual physical delivery. It's estimated that for every ounce of physical gold that exists, There are probably 50 to 100 ounces of paper claims on gold through various futures, options, and derivative contracts. This creates a system where entities with enough capital can move paper prices significantly without having to actually buy or sell much physical metal. It's a vulnerability in the market structure, and there's increasing evidence that sophisticated players are exploiting this vulnerability systematically. The Shanghai connection adds another fascinating dimension to this whole situation. China's gold market operates somewhat differently from Western markets. There's much more emphasis on physical settlement, and the Chinese government has been actively encouraging its citizens to buy gold for years. The Shanghai Gold Exchange, which is different from the Shanghai Futures Exchange but connected to it, has been positioning itself as a potential alternative to London and New York for gold price discovery. There's a quiet but very real competition happening between Eastern and Western financial centers for control of precious metals pricing. This recent coordinated crash could be seen as a battle in that larger war. If Western institutions can demonstrate their ability to crash prices even in Asian trading hours, even on Asian exchanges, that's a show of force. Conversely, if Eastern buyers can absorb that selling and continue accumulating physical metal, that demonstrates their strength and resolve. Let me share with you some of the warning signs that informed observers had noticed in the weeks leading up to this crash, because in hindsight, the signals were there if you knew where to look. The commercial traders, which is the category that includes major banks and institutions, had been building record short positions in both gold and silver futures. This data is publicly available through the Commitment of Traders reports published by the CFTC, the Commodity Futures Trading Commission. When commercial traders are heavily short, it often precedes price declines. But the scale of the positioning this time was extraordinary, even by historical standards. Some analysts were calling it the most extreme positioning they'd ever seen. Additionally, there had been unusual options activity in the weeks prior, particularly in put options, which profit when prices decline. Large purchases of out-of-the-money puts, betting that gold and silver would fall significantly, were documented. Now, it's possible this was just smart money making informed bets based on technical analysis or fundamental views, but it's also possible, some would say probable, that these were positions being established by entities who knew that a major price attack was being planned. If you're going to manipulate prices downward, of course you'd want to have positions in place that profit from that move before you execute it. That's just basic front running, and while it's illegal, proving it in court is notoriously difficult. The regulatory response to this event has been, let's say, underwhelming. The CFTC has made no public statements suggesting they're investigating potential manipulation. The CME Group issued a bland statement saying that their systems operated normally and all trades were executed according to the rules. Chinese regulators have been even more opaque, offering no public comment at all. This regulatory silence is deafening to those of us who believe something seriously improper occurred. When you have a market event this dramatic, this unusual, this potentially damaging to investor confidence, you'd expect regulators to at least announce they're looking into it. The fact that they're not suggests either incompetence or, more troublingly, complicity, or at least willingness to look the other way. Now, I want to address the counter-arguments here because it's important to be fair and consider alternative explanations. Skeptics of the manipulation thesis would point out that markets are volatile, that large price moves happen, and that correlation doesn't necessarily mean coordination. They'd argue that maybe there was some fundamental factor that drove the selling, something subtle that most observers missed. Perhaps there was concern about emerging economic data from China. Maybe there were whispers about Federal Reserve policy that spooked investors. It's possible that this was just a case of herd mentality, where some initial selling triggered algorithmic trading systems that amplified the move, creating a feedback loop that crashed prices without any deliberate manipulation. These are fair points, and I want to acknowledge them. Markets are complex systems, and sometimes complex outcomes emerge from relatively simple inputs without anyone pulling strings behind the scenes. However, the counter-arguments don't adequately explain several key facts. They don't explain the precise timing coordination between exchanges. They don't explain the absence of any fundamental catalyst. They don't explain the specific pattern of stop hunting that was observed. They don't explain the immediate surge in physical demand that followed the paper price crash. They don't explain the record short positioning that preceded the event. Any one of these factors alone might be coincidence, but when you stack them all together, the picture that emerges is one of deliberate, coordinated manipulation. So where does this leave us? What are the implications for investors, for markets, for the broader financial system? First and most obviously, if you're invested in precious metals, you need to understand that the markets you're participating in may not be as free or as fair as you'd like to believe. Price manipulation is not a theoretical concern, it's a documented reality, and this recent event suggests it's ongoing and perhaps even escalating. That doesn't necessarily mean you shouldn't invest in gold and silver. Many would argue that if powerful entities are working this hard to suppress prices, it actually suggests that precious metals represent a real threat to the current monetary system, which in the long run might make them even more valuable. But it does mean you need to go into these markets with your eyes open, understanding the risks. Second, there's a broader question about market integrity that extends far beyond just gold and silver. If major exchanges can be manipulated this blatantly, if regulators are either unable or unwilling to act, what does that say about other markets? Are stock markets subject to similar manipulation? Currency markets? Bond markets? The uncomfortable truth is that once you start pulling on this thread, you begin to question the integrity of the entire global financial system. And maybe that questioning is healthy. Maybe we need to have a serious conversation about whether our markets are really serving their intended purpose of fair price discovery and efficient capital allocation, or whether they've become playgrounds for the ultra-wealthy and the politically connected to extract wealth from everyone else. Third, and this is perhaps most important for your immediate future, this event should serve as a wake-up call about the importance of diversification and risk management. The traders who got absolutely destroyed in this crash were often the ones who were over-leveraged, who had too much of their capital concentrated in a single position, who weren't properly prepared for extreme volatility. The lesson here isn't necessarily to avoid precious metals or futures markets, but to approach them with appropriate caution, position sizing, and risk controls. Never put yourself in a position where one bad day, one manipulated market move can wipe you out completely. Looking forward, I think we're going to see this pattern continue and possibly intensify. The forces that drove this coordinated attack, whatever they may be, haven't gone away. If anything, the successful execution of this price crash will embolden those behind it to try again. We're likely to see more extreme volatility in precious metals markets. More instances of sudden, dramatic price moves that don't align with fundamentals. For investors, this means staying alert, staying informed, and being prepared for both significant risks and potentially significant opportunities. When prices get artificially suppressed, it can create buying opportunities for those with patience and proper risk management, but it can also create traps for the unwary. The battle for control of precious metals pricing is ultimately a battle about monetary power and trust. Those who control the price of gold control, to some extent, the narrative around currency value and economic stability. It's no accident that governments throughout history have tried to control gold. Went from Roosevelt's gold confiscation in 1933 to Nixon closing the gold window in 1971. Gold represents an alternative to government-controlled money, and those in power have always viewed that alternative with suspicion and hostility. The recent coordinated crash across CME in Shanghai is just the latest chapter in this very old story. What happened that Sunday night going into Monday morning wasn't just a market event. It was a demonstration of power, a reminder of who really controls these markets, and a warning to anyone who thinks they can challenge that control. Whether you view it as market manipulation by shadowy cabals or as aggressive but legitimate trading by well-capitalized institutions, the result is the same. Significant wealth was transferred from less informed, less powerful market participants to those with superior information, resources, and connections. That's the reality of modern financial markets, and while it may not be pleasant to contemplate, understanding it is essential for anyone who wants to protect and grow their wealth in this environment. The truth is out there in the data, in the patterns, in the suspicious timing and coordination. Whether regulators will ever acknowledge it, whether the mainstream media will ever seriously investigate it, remains to be seen. But for those of us paying attention, the evidence is clear enough. Something happened that night, something coordinated and deliberate. And it's part of a larger pattern that every investor needs to understand. Your financial future may depend on it.